Gold is not rallying, it's repricing, and the spread is the part the headline traders can't control. The conflict right now is simple. One side keeps calling this a fear spike that will fade the moment the news cycle calms down, and the other side is watching the market behave like it's under mechanical pressure, the kind that doesn't care what you believe. Because when the engine is market structure, price can look irrational right up until the moment it snaps into a new range and never gives you the clean pullback you were promised. And before we're done, you're going to have 3 things you can actually use this week: the level that matters more than the $5,000 headline, the signal in the curve that tells you whether this move is real or just a crowded chase, and the exact kind of price action that would invalidate the whole $7,000 peak narrative, while most people are still cheering. Here's the context. Right now, not a history lesson, gold started January in the low to mid 4,300s. And in a matter of weeks, it accelerated into the upper 4,700s and then into the $4,900 neighborhood, flirting with that psychological $5,000 line like it wants to leave it behind. That speed matters more than the number. Markets don't drift into a new era politely. They lurch, they gap. They punish the people who demand perfect entries. And if you're watching this with even a little skepticism, and you should, your job is to separate the emotional story from the structural story, because those two can produce the same chart for completely different reasons. And that's where the real pressure starts, because the loudest pushback is, it's just panic buying, it's just geopolitical noise, it's just a crowded trade. But crowded trades don't usually climb this clean while the market keeps finding bids on dips. Crowded trades don't usually hold their ground when volatility rises and everyone gets a little jumpy. And crowded trades definitely don't usually show you subtle stress in the parts of the market most retail traders never look at, like spreads, roll costs, and the curve that quietly decides who is forced to act and who gets to wait. But that's not the part that matters. The part that matters is what's happening under the hood, where paper gold and physical gold aren't the same thing, and where the cost of carrying metal through time becomes a kind of hidden tax that can suddenly jump. If you want the hidden detail in one sentence, it's this: the carry math is changing, and when carry math changes, it forces awkward decisions from hedgers, arbitrage desks, and anyone who needs exposure without holding bars. And that reshapes the curve, and when the curve reshapes, spot price follows more often than people want to admit. Most people are trained to look at gold like it's a single price on a screen, but in reality, gold is a time structure. Spot, forwards, futures months, lease rates, funding, and delivery, all stitched together by arbitrage. In normal conditions, you usually see contango, future prices slightly higher than spot, because you're paying for time, storage, insurance, financing. That's the cost to carry. It's boring. It's supposed to be boring. And when it stops being boring, that's a flare in the night. Because if the curve flattens too much, or if parts of it invert, that's the market whispering. That immediate metal is more valuable than promised metal later, or that financing conditions and availability are tightening in a way that makes waiting expensive. That's not conspiracy. That's incentive. That's participants responding to constraints. And if you've never watched a market get pushed around by constraints, precious metals are a masterclass. Here's the street symptom that gives the game away. When markets are calm, physical is an afterthought, and everyone talks in tidy percentages. When markets are stressed, the conversation turns into timelines, sourcing, and can you actually get it when you need it? That shift doesn't always show up as a dramatic shortage headline. Sometimes it shows up as small frictions, delivery windows that feel longer, premiums that stop compressing the way they should, and a subtle change in tone from the people who actually handle the metal. And if you're thinking, okay, but how does that get you to $7,000? Good, because the path matters more than the peak. 7,000 isn't a number you chant into existence. It's a peak you earn through sequence. A regime where structural buyers keep showing up, where the curve and spreads don't relax, and where every dip turns into someone else's procurement opportunity. That's the next detail that flips the whole setup. The popular story is, gold goes up when fear goes up, sometimes. But the more interesting story is, gold goes up when the market starts treating sovereign credit and currency credibility as variables, not constants. And that can happen even when rates are high, even when the dollar isn't collapsing, even when the news is noisy and contradictory. Because gold is not just an inflation hedge, it's an alternatives hedge. It's a trust hedge. And when trust becomes a line item in risk models, the bid changes character. You can see that in who's buying. Retail buys when it's excited and it sells when it's scared. ETFs tend to amplify whatever the crowd is already feeling because they're a clean on-ramp and a clean off-ramp. Central banks are different. Central banks buy like a policy decision, not like a trade. They buy because they want less dependence on someone else's promises. And when central banks are buying and ETFs start buying at the same time, you don't just get a rally, You get a tightening of the available float that can feed back into the curve and spreads. Because if the marginal supply is being tucked away by entities that don't care about the daily chart, liquidity thins, price becomes jumpier, and that's when impossible targets become less impossible. Not because gravity disappeared, but because the order book got shallower than people realize. And that's where the real pressure starts. Now add the macro layer, and this is where people get lazy. The lazy model says, higher real yields should be bearish for gold. Full stop. But markets don't live inside single variable models. There are periods where gold can rise with yields, not because gold forgot the rules, but because something else became more important than the opportunity cost of holding a non-yielding asset. Think about what the market has been learning over the last few years. Reserves can be frozen, trade can be weaponized, fiscal paths can widen, and political risk can turn into policy risk faster than anyone expects. In that environment, gold doesn't need yields to fall to be attractive. It needs credibility to wobble. It needs diversification incentives to strengthen. It needs a reason for large pools of capital to prefer an asset that isn't someone else's liability. And if you want a clean, finance-literate way to say manipulation without sounding cartoonish, it's this. Market structure has incentives. Banks, dealers, and funds manage risk. They manage inventory. They manage funding. They don't wake up and decide to play villain. They respond to constraints and profit opportunities. And when constraints tighten, their behavior can look like suppression one day and acceleration the next, because the same mechanism can push both ways depending on positioning. The next detail is what flips the whole setup. Let's talk positioning and reflexivity, because this is the part that creates the how did it move that far that fast moments. In a big liquid market, you'd think opinions dominate. They don't. Exposures dominate. When volatility rises and price pushes into new territory, the people who sell options and make markets have to hedge. If dealers are short calls because the market is buying upside exposure, dealers hedge by buying the underlying as price rises. That's delta hedging. And when the market is in a certain configuration, when gamma is positioned in a way that makes hedging flows pro-cyclical, price going up forces more buying, which pushes price up more, which forces more buying. That's reflexivity. It doesn't require conspiracy. It requires a crowded set of strikes, a rising tape, and risk managers doing what risk managers do. And you don't need exact options data to respect the possibility because you can see the signature. A market that holds gains dips that get bought quickly and late day pushes that feel like they're being managed by hedging rather than emotion. But that's not the part that matters most for gold specifically. Gold has another reflexive channel, short covering and margin pressure. When gold rips and volatility rises, anyone who was short because it always mean reverts starts to face a different problem. It's not just mark-to-market pain, it's collateral. It's margin. It's the phone call that says, reduce exposure. And in metals, where leverage is common and futures are central, margin dynamics can turn a thesis into a forced exit. Shorts cover into strength. That strength triggers more risk reduction. That risk reduction becomes buying. And suddenly the market isn't moving because new believers arrived. It's moving because disbelief is getting liquidated. And that's where the real pressure starts. I'll bring it back to the hidden detail, carry math. In a smooth world, if spot is X and futures are X plus carry, arbitrage keeps everything tidy. If futures get too expensive relative to spot, you sell futures and buy spot. Carry the metal, deliver later, pocket the spread. If futures get too cheap, you do the reverse. Those actions are supposed to keep the system in balance. But arbitrage isn't magic. It depends on funding, on balance sheet, on the ability to source metal, on the willingness to tie up capital, and on the friction of logistics and refining. When any of those get constrained, even modestly, the curve can stop behaving textbook. And when the curve stops behaving, it tells you something about stress that spot price alone can hide. For example, if later months aren't offering enough premium over spot to compensate for financing and risk, holders of physical become less willing to part with it. If holders of physical become less willing to part with it, nearby supply tightens. If nearby supply tightens, spreads can widen in ways that don't need a screaming headline. And then when a rush of demand hits, industrial procurement, ETF inflows, central bank buying, or risk-off hedging, there's less loose metal to absorb it. So the market does what markets do. It raises the price until supply shows up or demand backs off. And the higher the price goes, the more it pulls in attention, which can pull in more flows. That's the loop. That's the math. This is why people who only watch spot get blindsided, because they're watching the shadow on the wall, not the hand that's moving. But that's not the part that matters. The part that matters for you as a retail investor or macro watcher is, what do you watch next to avoid getting hypnotized by the $7,000 headline? You watch the proof stack. You don't marry a number. You monitor a set of signals that either keep confirming the regime or start quietly breaking down. Here's the proof stack that makes this story evidence-driven instead of vibes-driven. First, chart structure. Not in a mystical way, just structure. A market that breaks to new highs and then refuses to give back the breakout area is telling you demand is stepping in faster than supply. If gold is carving higher lows while pressing against that $4,900, $5,000 band, it's building a platform. Platforms are dangerous because once they resolve, the move can be sharp. Second, the term structure and roll behavior. You're not looking for perfection. You're looking for confirmation. Does the curve remain firm, or does it relax the moment spot pauses? If it relaxes aggressively, that can mean the stress was temporary. If it stays tight, that suggests real demand and/or constrained willingness to lend metal through time. Third, institutional flow behavior. When big banks and strategists start upgrading forecasts, it's easy to roll your eyes, and you should because forecasts are marketing. But the signal isn't the target, the signal is the rationale. If the rationale is consistently about central bank accumulation and ETF demand returning, that's a fundamentally different engine than fear this week. Fourth, global comparison and arbitrage. Where is the urgency coming from? If demand is concentrated in certain regions, price can get pulled by arbitrage through the lowest friction channels, and that pull can persist. Fifth, real-world frictions. Not dramatic shortages, frictions. If the physical market is calm, premiums compress and delivery gets easier. If it isn't, frictions persist. And sixth, positioning volatility signature. Do dips get bought quickly? Do rallies hold into the close? Does volatility rise with price in a way that suggests hedging flows rather than capitulation? Stack those together and you stop needing a single reason for every candle. And that's where the real pressure starts. Now let's address the $7,000 peak forecast with adult logic. A $7,000 peak is not a baseline. It is a tail outcome that becomes plausible when three forces overlap. Structural demand that doesn't care about price, a market structure that amplifies upside because of hedging and margin dynamics, and a supply float reality that can't respond quickly. Gold supply is not like shale oil where you drill and flood the market in months. Mining lead times are long, capital cycles are slow, and incremental supply is sticky. Recycling helps at the margin, but it's also price sensitive and not instantaneous. Refining and logistics have bottlenecks, and crucially, a lot of gold is held not as inventory, but as insurance. People who hold it as insurance don't sell just because it's up. They sell when their reason for holding it disappears, and those reasons can linger. So the path to a $7,000 peak would likely look like this. Gold breaks and holds above major psychological zones. Volatility rises funds that under-owned gold chase. ETFs accumulate, central banks keep buying into strength, and the curve refuses to relax, signaling that the market is paying up for time and availability. In that sequence, you don't need everyone to become a gold bug. You need enough systematic money to be underweight and forced to rebalance, and enough discretionary money to see that the old ceiling is gone. Because once a market sets new highs, it changes the conversation. It changes the mandate discussions in institutions. It changes the risk committee tone. And the next detail is what flips the whole setup. When institutions are late, they don't nibble. They size. They ladder. They buy on signals. That's why peaks can overshoot. Not because the world ended, but because allocation caught up in a hurry. But that's not the part that matters. The part that matters is the near-term roadmap, because this week and next week are where people get chopped up. If gold is hovering near the upper $4,800 to $4,900s and probing $5,000, you need to respect two things at once: the trend signal and the noise. Trend signal is the market's ability to hold above prior breakout areas. Noise is the intraday violence that can be used to punish late buyers and scare out early holders. The market loves to do this. It runs the headline, it pulls in the crowd, and then it snaps back just enough to make everyone feel stupid. And then, once the weak hands are shaken out, it resumes. That's the psychology trap. So here are the levels in a way that keeps you grounded without fake precision. 1, the psychological band, $4,900 to $5,000, is not just a number. It's a behavior test. If price tags it and rejects hard, that's information. If price tags it, pulls back, and then holds above the mid to upper 4,700s, that's different information. 2, the recent breakout zone around the mid 4,600s to 4,700s area is the kind of region that often becomes support if the regime is real. If gold loses that region and can't reclaim it quickly, the market is telling you the bid is not as urgent as it looked. 3, the prior consolidation areas in the low to mid 4,500s become the line in the sand for the near-term momentum narrative. If gold falls back there, the market can still be bullish long-term, but the right now squeeze-like acceleration thesis weakens, and that's where the real pressure starts. Now the calendar trigger, because this is not optional. The calendar is often the catalyst in commodities and metals. Not because dates are magical, but because balance sheets and mandates are real. Month-end can force rebalancing, funds roll exposures, dealers adjust hedges, options expiries can concentrate flows around key strikes, delivery windows and futures positioning can tighten or relax depending on who needs what when. If you've ever watched a market feel possessed around a certain week, it's often because liquidity is thinning while mechanical flows are peaking. In late January, you're staring at the kind of period where one large order can move a thinner book and where risk managers are particularly sensitive because the month's performance is being printed. That doesn't mean straight up. It means the moves can be sharper in both directions. It means gaps are more likely. It means the market can use volatility as a weapon. And if this thesis is correct, volatility will be the tool used to separate disciplined holders from reactive traders. That's the viewer psychology shield you need. Because if you're right about direction but wrong about timing, the market can still take your money. And that's not moral, it's structural. Here's how you protect yourself mentally without turning this into investment advice. First, you decide what kind of participant you are in this move. Are you watching for a swing over the next week or two? Or are you watching the macro regime over months? Those are different games. The mistake is mixing them. People claim they're investors and then react like day traders. Second, you define the invalidation before the volatility hits. Not because you need to be stubborn, but because you need to be consistent. If your thesis is new regime and accelerating, then a failure to hold the breakout zone and a loss of key support regions is a signal that the near-term acceleration is pausing or reversing. You don't need to panic, you need to update. Third, you treat headlines as lagging indicators. The market moves first, the narrative chases. If you let the narrative control your emotions, you become liquidity for someone with a plan. And that's where the real pressure starts. Now let's lay out the two scenarios cleanly, because this is how you keep credibility in a world that loves one-way predictions. Scenario 1 is the controlled pullback and retest. In this scenario, gold pokes above the psychological zone, maybe even briefly tags a new high, and then pulls back in a way that feels uncomfortable but orderly. It finds buyers above the prior breakout region. It churns, it compresses, and then it grinds higher again. The confirmation here is behavior, dips that get bought, shallow retracements relative to the prior leg, and a curve from our spread structure that doesn't relax dramatically. If spreads stay firm and the market holds key zones, that's the kind of base building that sets up the next push. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, gold doesn't give you the clean retest. It accelerates through the psychological band, liquidity thins, and you get one or more impulsive days where price jumps and everyone scrambles to figure out why. That's often when options, hedging, and short covering mechanics are at their most violent, because once a level breaks, the math changes. Dealers who were comfortable suddenly aren't. Shorts who were patient suddenly aren't. Funds that were underweight suddenly face tracking error and mandate risk. The confirmation here is speed and refusal to mean revert. Price breaks, holds, and closes strong, with shallow dips that get erased quickly. The danger here is also obvious. Gap risk works both ways. If you're chasing, you can get trapped. If you're positioned, you can still get shaken out by a savage pullback that's purely liquidity driven. And that's why the psychology shield matters. Because if you're going to live in a market that can move like this, you need a rule that isn't my feelings. But that's not the part that matters most. The part that matters most is recognizing what would weaken the $7,000 peak narrative. Because being bullish without an invalidation is how you become a story, not a strategist. Here are the big three. 1, the curve relaxes hard. If the market stops paying up through time, if spreads ease, if the carry math normalizes quickly while spot stalls, that can be a sign that the stress component was transient. 2, institutional flows fade while price keeps trying. If the rally becomes purely headline chasing with no evidence of persistent allocation, it becomes easier to reverse. 3, price structure breaks. If gold loses the key breakout zones and fails to reclaim them on the first meaningful attempt, you're not in an accelerating regime. You're in a correction inside a longer-term uptrend at best. That doesn't kill gold. It kills the near-term supercycle narrative people are trying to sell you, and it's okay to separate those. In fact, that separation is what keeps you from becoming exit liquidity. And that's where the real pressure starts. Now, let's zoom out just enough to make the $7,000 peak concept make sense without turning it into fantasy. When markets enter a new regime, they often overshoot because the reference points change. People anchor on old highs. They anchor on old valuation models. They anchor on what should happen. But a regime shift isn't a debate, it's an outcome. If enough capital decides that gold is not a trade but a strategic allocation, especially if that decision is reinforced by central banks and reflected in ETF accumulation, then the marginal buyer becomes less price sensitive. That's when peaks become more about flow exhaustion than valuation. And flow exhaustion tends to happen at levels that feel absurd in hindsight, precisely because they're not being set by careful bargain hunters. They're being set by forced buyers and late allocators. Think of it like this. The first phase is disbelief and shorting. The second phase is begrudging acceptance and buying dips. The third phase is performance chasing and chasing breakouts. The final phase, the peak, is where the market teaches everyone the same lesson at once. Liquidity is not infinite. If gold were to peak around $7,000, it would likely be in a period where volatility is high, headlines are loud, and the move feels like it's happening faster than your ability to process it. It would probably not be clean, it would probably not be polite, and it would almost certainly come with the kind of pullbacks that make you question your sanity. Which is why you should not frame this as, will it hit $7,000, but as what sequence would make that plausible, and what evidence tells me the sequence is developing. That's the whole game, and that's where the real pressure starts. So let's bring this home into an actionable watch list mindset for the next week or two. Watch the behavior around that psychological band near $5,000. Not because round numbers are magic, but because they concentrate attention and positioning. Watch whether pullbacks hold above the mid to upper $4,700 region that has been a recent pivot area. Watch whether the market can keep printing higher lows without bleeding back into older consolidations. Watch the feel of the tape. Do sellers get follow through or do they get absorbed? And most importantly, watch whether the market structure confirms what spot is trying to do. If the curve and spreads keep signaling tightness, meaning the market is still paying for immediacy and still reluctant to cheapen forward exposure, then the rally has legs beyond emotion. If the structure relaxes while spot hesitates, then the move may be due for a deeper reset. And that reset could still be bullish long term, but it changes the near-term playbook. Because if this one level breaks, the math changes. Here's the last psychological tool you need, because this is where viewers get manipulated. The market will try to turn you into a reaction machine. It will give you a sharp drop on no news. Then it will give you a sharp rally on a headline that sounds like it explains the entire universe. Then it will reverse again. The goal is not to inform you. The goal is to make you do something impulsive. Sell low, buy high, and blame yourself. Your defense is to treat volatility as a cost of admission, not as a verdict on the thesis. If you can't tolerate volatility, you can't play in a market where structural repricing is happening. But if you can tolerate it, you can avoid the most common trap, confusing noise for a broken trend. A broken trend is structural failure. Loss of key zones, failed reclaim attempts, and confirming weakness in the curve are spreads and flows. Noise is violence that resolves quickly and gets bought. Learn to tell those apart, and you'll stop being surprised by the same trick in different costumes. And that's where the real pressure starts. So yes, a $7,000 peak is a dramatic forecast. But it's not crazy in a world where structural buyers are real, where the market is repricing trust, where the curve can signal stress, and where reflexive flows can accelerate a move beyond what static models predict. Just don't fall in love with the number. Fall in love with the mechanism. Watch the structure. Respect the calendar. Expect volatility to be weaponized. And keep a two-scenario lens, so you were never trapped in one narrative when the tape is clearly choosing another. If you're still here, you're already in a different class of market participant than the people who only show up for the headline, because you're demanding a mechanism, not a slogan. Stay with that. Build your watch list. Compare what you see in price to what you see in structure. And if you want to keep running this like a real macro desk, targets, invalidations, and the signals that matter, stick around with the community that treats markets like systems, not like stories.